Hello everyone, and welcome to our webinar on this 52nd GST Council meeting. Like previous meetings, this meeting also had a range of clarification and proposed changes which the government has proposed, which would be relevant for taxpayers at large. So in this webinar, we'll be focusing on two topics. Firstly, ISG mechanism, practical challenges. So while the one important point was that initially the government issued a circular wherein they said that ISG and cross-charge, they cleared the air around it. They said that for past period, ISG is not mandatory, but going forward, it would be made mandatory. So there was a circular which was issued. However, legislative changes were not proposed. Now, in this GST Council meeting, these legislative changes have been approved, and they have said that those would soon be introduced in through the amendments in the GST Act as well as in the rules. So, once they are implemented, what would be the practical challenges? We'll be discussing those. The second part is the personal and corporate guarantee open points. And lastly, what are the other proposed changes and clarifications? So, me and Rishabh would be happy to take this webinar. Moving forward to the first topic of ISG mechanism practical challenges. So again, as we all know, ISG, the legal provisions are already in place in the CGST Act. We have the definition of ISG, which is a person who receives an invoice and issues a prescribed document for distributing ITC. Then we have section 30 or 20, which says how this ISG credit would be distributed. We have rule 39, which supplements section 20. And then we have section 24, which is for compulsory ISG registration. What this GST Council has done is, it has said that ISG mechanism would be made mandatory, as was suggested by the circular. And they have also said that necessary amendments would be made in section 20, rule 39, and section 261. What we can look forward to is when the Finance Act 2024 would be introduced, there would be these changes in the CGST Act which would be there. Of course, even though it is introduced and implemented, there would be some time which would be there for taxpayers because all the states would also have to ratify the same. So there would be changes in the CGST Act, there would be changes in all the respective SGST Acts, and then it would be implemented. So taxpayers do have some time before this amendment comes into place. However, in this webinar, we'd just like to discuss and highlight it would not be a very smooth change for taxpayers because of the complexities that surround in implementation of ISG mechanism. So what are the present procedural requirements which are there for ISG? Firstly, there is a separate registration which is required for ISG. So unlike, and many of us, I understand, are following cross-charge till now, because many questions which you got for the webinar were also of what cross-charge is, whether it would be mandatory or not, and we'll be taking all those questions. But the idea is, till now, whosoever is following cross-charge had a normal GST registration, but ISG requires a separate registration altogether. Then the ineligible ITC is also to be distributed by ISG. So if you see the distribution mechanism, ISG not only has to distribute what the eligible ITC is, but if let us say there is a credit which is barred under section 17, like for food and beverages, for outdoor catering. So all the service credit which it receives is also to be distributed. Then there is a mandatory monthly distribution which is required to be done. So if you see under cross-charge, what happened was several of the companies, they took a call that they will be distributing the credit quarterly, which is an easier mechanism that during the quarter, whatsoever ITC is received, at the end you are providing services on a quarterly basis, on a continuous basis, and therefore you distribute that. But ISG mechanism mandates that the monthly distribution is required. In fact, some of our clients have even gotten notices wherein, because the invoice was for previous period, but they received the invoice in next period. So taking an example, the invoice was dated Feb, but they received the invoice and made distribution in March. The department said no, because there's a monthly distribution mandate, you should have distributed in Feb, which is quite illogical because unless and until they have received the invoice, how can they distribute it? But this is, I'll say, because of this condition, this is the problem which one of the taxpayers faced. Then next, and very, very important, is basketing of services. Till now, what happened was cross-charge gave you a liberty, because under cross-charge, the valuation was not very strict and you could adopt any value, because for most of the clients or for most of the taxpayers, the recipients are eligible for ITC. But now when you come to ISG, that option is no longer open. So you have to basket services basis multiple conditions or basis multiple criteria. One is to whomsoever, you can say firstly unit wise. So if let us say an SSC has 4 units, he'll have to basket to which all unit a particular service relate. 1, 2, 3 or 4. So there can be multiple permutation combinations there. Second, some services can be product basis also. So one has to identify to which product the service relates, which can lead to a different answer in that sense. So basketing of service, particularly we foresee, would be quite complex under ISG. And we will be discussing some practical examples for there. Then next is distribution in the proportionate of turnover. And cross charge again, because valuation was an option which was there for taxpayers, that was sometimes used for taxpayers to strategize that basis the ITC accumulation in recipient units, they can increase or decrease the cross charge amount and therefore credit which would be available to those units. But in ISG, it's a strict formula wherein you can only distribute in the proportion of turnover. And turnover also, how it is to be computed, we'll discuss in subsequent slides. But basically, turnover of last year is to be considered for distribution of credit. And then last point is the complications for RCM transactions. So for RCM transaction, ISG does not allow you to make payments for RCM. So presently, even if for a particular unit taxpayers who are following ISG, they also have a normal registration in that state, even if they are not providing any services or supplying any goods from there, to avail that ITC, to then cross charge it to the ISG location, and then ISG distributes his RCM credit. So for RCM particularly, this complexity is there under ISG till date. So now moving on to some of the practical challenges which we foresee would be there, and we'll be discussing through practical case studies of how the credit would be distributed. Before that, we'll also discuss one issue which companies face, or one thing which you should be conscious while distributing credit of ITC is how is the credit of ITC distributed. So taking an example, let us say a corporate has a head office in Gurgaon, but he has manufacturing units in Delhi and in Rajasthan. So he would be getting ITC, which can be number one CGST or SGST, or secondly, he can also get ITC which is in the nature of IGST. So taking that example, so let us say the ISG state A, and the recipient state can be the same state A, or it can be a different state. So if he gets the IGST credit, he can only distribute it as IGST credit. So even though, let us say in my example, in Gurgaon, if let us say, if he gets an IGST credit and he has a manufacturing unit in Haryana, he can only distribute that IGST credit as IGST to Haryana unit also. So even though both the locations are in same state, the credit distributed would be IGST. It would not change the nature to CGST and SGST. However, taking the next example, if the inward credit is CGST, ISG state A, recipient state can be state A or state B. Herein the answer differs. So if it is CGST has been inward and the recipient credit is same state, it would be CGST. But what if the recipient credit changes, like in this example, state A and state B? So Gurgaon or Rajasthan or Gurgaon or Delhi. In that case, CGST cannot be distributed. Logically also, because how would Haryana's CGST be distributed or allowed as Rajasthan CGST or Delhi CGST? So in that case, they allow that the credit should be distributed as IGST. And similarly for SGST also the same thing continues. So if the inward is SGST, the outward would be IGST. Now again, this mandates that the procedures are proper. The rules which and cross charge were there, that same state it would be CGST, SGST, and in different state it would always be IGST. The rules of a tax credit being transferred to be CGST or IGST differs depending upon multiple points. Number one, what is the type of ITC which has been availed? And secondly, whether the recipient location is the same state or different state. So yeah, these are another set of problems which the companies distributing credit through ISD face of setting these procedures and protocol so that credit is not distributed in a wrong manner. Now, moving forward, again, as we said that we'll be discussing several examples of how this ISD mechanism would work. We'll be taking example of a company which has, let us say, two products and uh, operations in different states. So in this example, they have operation in 4 states. So product A is being sold in state E, F, and G, and product B is sold in state G and state H. Let us start with the simplest example. So let us say he receives an audit service. So the corporate office receives an audit service, and audit service is common to all the locations. So how would this credit be distributed? So take in this example, because the ITC relates to all the units, then it would be distributed to all the states. It would be distributed to turnover ratio of such states of previous financial year. So again, a simple example. So audit service, it's common to all the states. It would be distributed in state E, F, G, and H. In what ratio? In ratio of the turnover of the previous financial year. Now let us then take an example of services which are exclusive to a particular product or a particular state. So we take an example, again the same example, but now the services are different. Now for product A, they receive a national advertisement which is exclusive to, they receive an advertisement from company P, which is exclusive to product A, but that is being televised across India. So, and similarly for company Q, they are receiving for advertisement for product B, which is only telecasted in state B. So anyone of the audience would like to try to answer in this? We can see if you are, if let us say anyone is raising hand and they'll try to answer of how this credit would be distributed. Anyone would like to try? We'll wait for a minute. If someone raises his hand and would like to try, I'll repeat the question. The scenario is that product A and product B, they are sold in different states. So product A is sold in E, F, and G. Product B is sold in state G and H. From advertisement company P, there is an advertisement which is telecasted across India. And for product B, there is an advertisement which is telecasted only in state H. Okay, so yeah, Mr. Anubhav, you had raised your hand. Would you like to try? Yeah, you can.
Hello, am I audible?
Yes, you are.
Okay, so the advertisement of product A was on national TV. So
Right,
we will check that product A are belonging to which states. So we can
right,
see that the product A is belonging to state E, F, and G.
right,
So the ISD should be distributed to these three states only, as the state
right.
H is not related to product A.
Very right.
Okay,
And
now
for this second advertisement from company Q,
Now, since the product B, although relates to two states, state G and state H, however,
right,
the advertisement was only done in state H. So the
right.
impact of these expenses would normally accrue to state H only. So
Very
it should
right, sir.
only be distributed to state H.
Very right, Anubhav ji. A valid answer. Just one last question, if you allow Anubhav for me to ask you. When you take the turnover for this company P, when they are distributing to E, F, and G, would you take turnover only of product A, or for state G, you will take the total turnover?
Sir, actually, we are only following cross-charge mechanism since quite a few
Okay,
times. So I will have to check the laws.
right, right.
How is it related to it?
No, no, I think the answer which you gave was till now right, so much appreciated, Anubhav.
Okay, sir. Thank you for a thoughtful question, which I will have to review after
Right,
this seminar.
right, right. So, Anubhav gave a valid answer. In this case, because the services of company B were only for product A, it would be distributed. It would be distributed to states E, F, and G. However, the turnover, it says of the state and not of the product. So the total turnover of the state would be considered and not only of that product. So even though you are seeing the product to which the company is being sold, once you select the state or the registration, then the total turnover of that state is considered. And then, as Anubhav mentioned, for services from company Q, it would only be distributed to state H. Right. So going to the next example, and again, I'll invite from audience only to give an answer. The change is that now one state has shut down its operations. So if you see F state is no longer in operations. Now we have during the year, let us say in August 2023, the operations were shut. And now we have only three states, E, G, and H. And just to simplify it, now from advertisement from company P, it's both the advertisements are on national television. So even for the second advertisement, it's on national television and therefore relate to multiple states. Again, I'll invite participants to answer and raise their hands if they want to answer of how this state would be distributed. I'll just repeat an example and give all of you a minute to think through. What the change in this example is, one of the units shut down, or one of the operations in one of the state are no longer there. So while they were there in the previous year, in this year in August 2023, the operation shut down. So when you're distributing ITC in September 2023, how would you distribute? I'm still waiting for someone to raise their hand. Yeah. Mr. Naveen Tiwari has raised. Anubhav has also raised, but now we'll allow Mr. Naveen ji to try. Yes, Naveen ji. You can unmute yourself and you can answer.
Yeah, am I audible?
Yes, Naveen ji.
Yeah. So the answer would be you will take the turnover of the last quarter, maybe.
Of the previous quarter, you said.
Not of the previous quarter, of the last quarter.
Of the last quarter, right?
Yeah.
But Naveen ji, the last quarter is there when you don't have the turnover of previous financial year of these states. Would you not have turnover of previous year for state E, G, and H?
We do have the turnover. So you were saying that we will take the turnover of the last quarter. I mean, we'll take the turnover of the quarter of the previous year.
No, but I'm saying by quarter. Why not the full financial year?
Because one unit is not there, we will not be able to distribute the credit to that unit.
So otherwise also when you take the turnover of the previous quarter, even then you will not be able to distribute.
Right, right.
So Naveen ji, if you allow, can we ask the next participant to answer?
Sure, sir.
Right. Yes. Honey, you can unmute yourself and then you can raise your try to answer.
We understand that since the ITC is only attributable to state E and G, it should be attributed to only these two states on the basis of the turnover of the preceding financial year.
Right, right. So, Honey, your answer is right. And so the point which we tried to raise was, and as Naveen ji also thought that the previous quarter should be there, the answer is it should be distributed to state E and G basis the turnover of the previous financial year. So
Right.
even though unit F has closed down, it's not that E and G did not have any turnover of the previous financial year.
Right.
So yeah, your answer is right that it would be distributed. Yeah, similarly for services from unit G or company G, those now relate to state G and H and therefore they'll be distributed. Just one second. They'll then be distributed to G and H basis the turnover of the previous financial year, because the turnover of the previous financial year is available. So nothing changes except the ratio when a unit is closed down. So this is what we have mentioned. F has been shut down in middle of the month and year. P would be distributed to E and G. Q would be distributed to G and H. The turnover ratio of the previous financial year of the such state should be there. Now, taking another example, and now what has happened is another unit has come up. So now the operations from state G of product A has shifted to state X. So new unit has come up. What would be the answer when the new unit comes up? Again, I'll invite from the participants only to answer of how the credit would be distributed in such case when a new unit comes up. Because now you'll not have the turnover of the previous financial year. Probably Naveenji, if you want to try in this, or someone else. Yeah. Naveenji, you can unmute yourself and answer.
Yeah, I think my answer through the previous question will apply here.
Right.
So
Right.
we'll take the turnover of the previous quarter.
Very right, Naveenji. So whenever the turnover of state X of the previous quarter is also available, you will take the turnover of the previous quarter and then distribute. But
Right.
that would be applicable for both the services or to one type of services.
For both the services, because unit is not available. I mean, there's a new unit here.
There's a new Naveenji, but when you so product P, I completely agree with your answer that it would be done basis the previous quarter for state E and X. But for services from company Q, which are attributable to state G and H, would you take previous quarter or previous year?
For that, previous year will be applicable. Yes, you're right.
Exactly. So for this, previous year is available, and therefore, because product B does not relate to unit X, so you can take the previous year as well. Right.
Thank you.
Thank you, Naveenji. So just I wanted, so this is the answer. And what we wanted to highlight is depending upon different scenarios, the ratios would change. For a multi-product, for a multi-unit company, the ratios may change depending upon one, to which units the service is allocable, number two, to which product the service is relatable, and three, if a new unit is added or reduced, the ratios would differ in all such cases. And even for shifting of the products, the ratio may change. So these are the challenges or these are the issues which the companies might face while distributing credit through ISG mechanism. And therefore, much cognizance for this distribution is required under ISG. So this, as we discussed in the slide, the answer to this. So moving forward, what other practical problems would be there for ISG, or what are the practical points which are there? Firstly, if you see for head office presently, what happens is through cross charge, you can distribute credit of both goods and services. ISG now only allows you to distribute credit of common services. What would happen to ITC of common goods? So if let us say there's a head office and it is receiving common goods, or for that matter, even employees. While the circular has said that for common employees, you need not cross charge, but what would happen for this employee cost? Should you rely on the circular and not cross charge, or would the cross charge mechanism still continue? So many of the questions, there were questions of, I'll answer both the questions before I come to these points. The first question was, after these amendments, would ISD become mandatory? Yes, it would become mandatory. Would it replace cross charge completely? The answer is probably no. It would not replace cross charge completely. Why? Because number one, as we told, ITC of goods, which is there, which need not be attributable to all units. Second, ITC of employee cost. If let us say these are services which are internally generated, which are not common services but internally generated services, cross charge would still continue for that. And thirdly and lastly, again, through the examples only which we are discussing, not all services would be common. So taking an example, a very generic example, let us say rent of the corporate office. The rent of the corporate office would actually not be a common services for manufacturing units, because the rent is not for the benefit of these manufacturing units. It's for the benefit of the corporate office itself, which is used for providing these internally generated services. So yeah, coming through this ISG, it's not that the cross charge would be eliminated completely. It is only that, yes, you'll have to firstly bifurcate which services are common, which are exclusive. So common might be audit services, which are for benefit of these manufacturing units. They can be other different services, warranty, consultancy services, etc. But some services which are actually attributable only to the head office, those services and which are used either internally generated or which are goods which are used there, or some services which are helpful for generation of these internally generated services would be then cross-charged only to different locations. Now coming to some practical points from ISG which differ from cross-charge. Firstly, and this is something which is very interesting, is the time limit of availing credit does not apply to ISG. So actually this is something which you can see can be borrowed from the previous law also and is applicable here also. So when you talk about section 16, it only deals with the timeline of availment of ITC. And ISG does not avail ITC, it distributes ITC. There is a fine but an important line of difference here. So because ISG as the mechanism, it does not talk about availment of ITC, and therefore the time limit should not apply. However, we will not suggest that you take this aggressive view regularly. It should only be taken if some ITC is missed and the amount is substantial. Second, another important point which sometimes is missed by ISG in mechanism is the matching condition is applicable. Because of provisions, when we read them in detail, they are made applicable to ISG also, and not only for cross-charge or to normal units. So this would be applicable. And lastly, for e-invoicing, the ISG receives the invoices. So if you are raising invoice to ISG, you will be raising an e-invoice. But when ISG issues an invoice, that's not an e-invoice. That's a normal invoice for which the ITC can be availed by the units. So that is it for ISG mechanism and the points which were there, including the questions that we had in the chat box. We'll take further questions during the end of the session. But now for personal and corporate guarantee and other proposed changes, my colleague Rishabh would be taking that.
Thank you, Deepak. Good afternoon, everyone. So moving further, firstly, we will be dealing with the personal and corporate guarantee, the issues that are surrounding. So as we all know that before the 52nd GST Council meeting, the revenue was aggressively disputing this issue as to the taxability of personal guarantee or the corporate guarantee. So the 52nd GST Council meeting has cleared the skies that were surrounding this issue, and these are the proposals of the 52nd GST Council meeting. So regarding personal guarantee, the council has said that a circular to be issued wherein it shall be clarified that wherein personal guarantee is given by the directors without any consideration, no GST shall be charged. Secondly, with respect to corporate guarantee, the council has proposed that a new rule shall be introduced in Rule 28 only, that is a sub-rule 2, which shall provide that in case of corporate guarantee, the value shall be higher of 1% of the guarantee amount or the consideration charge. So we can say at least 1% of the guarantee amount will be chargeable to GST in case of corporate guarantee. Now, for corporate guarantee only, a circular shall be issued which shall clarify that benefit of second proviso, which states that where the recipient is eligible to avail full input tax credit, the taxpayer may adopt open market value, or we can say the invoice value declared shall be deemed as the open market value. Now, this circular shall clarify that benefit of second proviso shall not be available. Now, so though the legislative changes have not been brought, so it would be interesting to see how the Rule 28 sub-rule 2 is worded, because if it overrides only the second proviso, it would cause a lot of problem. However, if it overrides 28(1), then the valuation mechanism is expected to be consistent. Now, some situations relating to personal guarantee which require consideration. So firstly, where the personal guarantee is given by the director and consideration is charged, and director is a related person as per explanation to section 15. So although the circular will clarify that the services are given without consideration, no GST is payable. However, in this case, since consideration is present and further director is also a related person, GST shall be chargeable, and taxpayers may take the benefit of second proviso to Rule 28. Secondly, where consideration is charged and now director is not a related person. So since director is not a related person, Rule 28 shall not apply. and normal valuation mechanism as stipulated in section 15 subsection 1, which is the transaction value, shall apply here. Now, third situation is an interesting one, which is even clarified, which shall be clarified by the circular, and it says that without consideration. So, irrespective of the fact whether the director is a related person or not, if the services are given without consideration, as will be clarified by circular, no GST shall be chargeable.
Just one important point here. While we have discussed the different situation that if consideration is there and director is related or not, and to some extent the background of the circular, while they have said that without consideration no GST would be exigible, basis can be led to an RBI circular which is clarified that when directors give guarantee, personal guarantee for companies, which are these directors are usually in the nature of promoters who are interested in the business and day-to-day affairs, they are barred from charging any consideration from the company. So the RBI has clarified that yes, banks would regularly be wanting these guarantees from the directors so as to ensure that the funds are not misappropriated. But second, it has also barred that yes, you cannot charge consideration. So this would be one interesting and important point which might have been in the mind of the taxpayers, the government, when stating that in absence of consideration, no GST can be charged. Because the RBI only states that you cannot charge any consideration, and therefore the open market value should also be nil, or no GST should be charged because it's more of a mandate from RBI. Yes.
So moving further, there are certain open points with respect to personal and corporate guarantee. Firstly, what shall be the fate of notices issued to the directors? So there was also a writ petition that was argued on this point, although the writ petition was dismissed. However, now the taxpayers who are in appeal may take the benefit of this circular with respect to personal guarantee, and we can expect that favorable orders shall be given because circulars are binding on the departmental authorities.
Yeah. So there are 2 points here. One is the many notices were issued to companies. And recently, another circular clarified that the services which are in personal in nature and not vis-a-vis in capacity of a director, those would not attract reverse charge. So because of that circular, the notices issued to the company would itself not hold any ground. But this becomes another additional and a more forceful argument that now this circular says no GST was payable and therefore notices either to directors or to company would not hold any ground.
So secondly is valuation of corporate guarantee for past period. So Rule 28 sub rule 2 is expected, that providing for 1% of the value of consideration for corporate guarantee. In our view, this rule is going to have a prospective effect, and therefore taxpayers may take the benefit of second proviso to Rule 28 for the past period. This in itself justifies the government's intent that taxpayers may take the benefit of second proviso. So yes, for past period, in case of corporate guarantee, valuation shall be as per second proviso to Rule 28. Next, valuation mechanism of 1% for exempted entities. So again, as we already discussed that it is very important to note how Rule 28(2) is worded. If in case it gives an overriding effect only to the second proviso to Rule 28, then there might be an issue with respect to the exempted sector. However, if it gives an overriding effect to entire sub-rule 1, then in that sense, we can say that the problem will be much sorted out. Like there will be no issues in interpretation.
So just one basic point here. While the government has clarified that the valuation should be done in this manner, an underlying issue which has not been resolved and which has actually been discussed or while replying to these notices, one issue which comes is whether it's a supply in the first place. So just to share with you, there's an Australian ruling which states that the activity of giving guarantee is not a supply itself. And they have considered the relationship between all the three parties, the guarantor, the guarantee, and the lender, and therefore come to that conclusion. So these guarantee arrangements needs to be analyzed, number one, to see whether there's a supply in the first place. Then secondly, if there's a supply, then yes, valuation, whether the government was allowed, prima facie they would be allowed, but then it would come down to, as Rishabh said, of how they draft the rules. And then lastly, for past period, because many companies, the government has almost to some extent forced them or told them to pay hefty amounts with interest. So for past, whether the basic amount, many companies must have taken credit, but at least for interest, whether refund can be claimed or not. All these issues would be something which some of the light would come from the GST Council minutes, which would come, or from the intent of the government for the past. And then balance studying these issues in detail, the companies can proceed with what call to be taken for past as well as for future.
So the last would be the direct tax implications for foreign related party. So in giving perspective to income tax, there may be transfer pricing implications that this may attract, and accordingly, like a call needs to be taken by the taxpayers. Like it may also have some transfer pricing implications. So next are the some other proposed changes and clarifications by the 52nd GST Council meeting. So first is the taxability of ENA. This was a very debatable, or we can say long-standing issue before the GST Council meeting, like it was being deferred again and again. There was also an Allahabad High Court ruling on this, whether ENA, which is used for manufacture of alcoholic liquor for human consumption, whether it will attract GST or VAT. The Allahabad High Court ruled that it will attract GST, and the revenue has brought this issue before the Supreme Court now. Now, the 52nd GST Council meeting has clarified that ENA, when it is used for manufacture of alcoholic liquor for human consumption, it shall not be subject to GST. So again, this is a welcome move, like GST shall not be levied on ENA when it is used for manufacture of alcoholic liquor, but it may raise certain issues which we will discuss shortly. Secondly, the council has clarified that when ENA is used for industrial use, it will attract 18% of GST. So now there are certain issues with respect to ENA when it is used for manufacture of alcoholic liquor. So firstly is that GST Council can exempt ENA. All right. But whether this change is prospective or retrospective, this needs to be seen basis the intent of the council. Secondly, what will be the fate of appeal that has been filed by the state of UP before the Supreme Court? Like it has challenged the levy of GST on ENA. So again, with this amendment coming in place, what will be the fate of this appeal before the Supreme Court? Nextly, we can say that there are many judgments which have held that ENA is not same as alcoholic liquor for human consumption. State governments presently have the power to levy VAT on alcoholic liquor. However, after this amendment, it is expected that the constitutional laws are amended and power is given to the state government to levy GST on ENA, to levy VAT on ENA as well.
So again, if you see the Allahabad High Court judgment, and the point there was that states do not have the power. In some other cases, the states have argued that the power is still there from GST because it says tax on supply of goods is both with center and state. So the Gujarat High Court negated this argument that you cannot, under VAT you don't have that power. This this power is federal in nature and therefore should be implemented simultaneously. It's not like a concurrent list which is there. So Gujarat High Court has dealt with this in detail. But again, when the GST Council have said that they would be gaming away this right to levy GST, are they proposing, or the states are also acknowledging that the constitutional amendments would be required, or they continue to levy VAT without the powers, only basis the GST Council deciding it, would need to be seen.
So moving further, an amnesty scheme has been introduced for filing of appeals. This is basically relating to the orders which are under 73 or 74 passed on or before 31st of March 2023. So appeal against these, and which were barred by limitation. So appeal against these orders can be filed till January 31st, 2024. However, a pre-deposit of 12.5% needs to be made, and of 12.5%, 20%, that is 5% of the total tax, we can say, needs to be deposited through cash ledger. Now, one important point that needs to be noted here is that the orders were passed under 73 or 74. The relief has been given only for 73 or 74, whereas e-way bill orders are generally passed under section 129. So no relief has been given for such orders. Secondly, with the council clarifying that at least 2.5% has to be paid through cash ledger. This denotes the intent that for pre-deposit, ITC can be also used for filing of appeals as pre-deposit.
Right.
So next, there are certain services to government, including government authorities. So entry 3 and 3A of the exemption notification, which stipulated certain pure services to central government, state government, these exemptions have now been retained. So there was a proposal that these exemptions may be discontinued, but the council has resolved that these services should be retained. Again, certain other services like water supply, public health, sanitation, etc., when provided to governmental authorities, will be exempt from GST. So this is an important clarification, or we can say that there was a miss earlier from the government. So as we all know that Section 16 of the IGST Act was recently amended to provide that on payment of IGST, the benefit of zero rating will be eligible to notified goods and notified suppliers only. The notification which came missed the word when the supplies are made to SEZ on payment of IGST. So there was ambiguity like whether supplies made to SEZ on payment of IGST, will they be eligible for zero rating benefits or not? The council has realized this miss and they have clarified that supplies to SEZs on payment of IGST will be eligible for zero rating benefits. Again, this is a regularization change, we can say, because Section 83, which deals with provisional attachment, already clarifies that provisional attachment shall cease to have effect after a period of 1 year. Now, realizing this, the government has also made a regularization change in the CGST rules to provide that provisional attachment shall cease to have effect after 1 year. So, Rule 159 is proposed to be amended for this purpose. Again, there was a lot of air surrounding GST Appellate Tribunal. Again, once again, the provisions were challenged before the Supreme Court, wherein the challenge was that advocates having a requisite experience are not being eligible to become judicial members. Now, the GST Council has said that advocates which have a minimum of 10 years of litigation experience across various tribunals, high courts, or the Supreme Court in relation to indirect tax, they will be eligible to become judicial members. So moving further, the council has proposed certain circulars as well, like a circular shall be issued for clarifying place of supply of following services. Firstly, it's relating to transportation of goods. Secondly, for co-location services, and thirdly, for advertisement services. Now, for transportation of goods, we all know that there were amendments made in Section 12 and 13 of the IGST Act. The transportation of goods, services by way of transportation of goods, the place of supply shall always be the location of recipient. So again, the circular is like, in our view, the circular will clarify these aspects only. Next is export consideration receivable in special Vostro account. So the council has clarified that as and whenever the export consideration is received in a special INR Vostro account, which is permitted by RBI, it shall satisfy the condition of export of services. And there was earlier also an RBI circular to this effect, which had clarified the same as well.
So we'll be wrapping up this session. Thank you for being such a great audience. Thank you.